What's going on, everyone? Market Monarch here. I hope you guys are doing blessed, man. You already know how I'm doing. So what I got for you guys today is the next episode into the Guide to the Market Mastery series. And what we're diving into today is money management. And honestly, I think that this is key to your path in order to become consistently profitable in these markets. This is what makes the difference between a successful trader or a successful individual in the markets and an individual who loses money in these markets. If you trade without a money management plan, you are essentially just wasting your time and your money because nothing will work for you, even if you have the most powerful trading system in the world. And most traders typically focus on how they enter the market, and they spend months and years looking for the right system, the right strategies. It's not to say that that isn't right, but if you only focus on the execution and not how you protect yourself within the trade, then you can just blow up accounts like that. A gentleman named Jesse Livermore. Now, I'll be talking a little bit more on him later in the video, but Jesse Livermore was a very successful trader, and he's known as potentially one of the best traders to ever live, or the best trader to ever live. Made a fortune in the market, and he also lost that fortune. And the reason why he lost that fortune was because he didn't stick to his rules. So it really does make or break you within this game. But without further ado, you already know how we do. Let's get into it.
It's easy to call yourself a trader, but it's very difficult to get to the level where you are a consistently profitable trader.
Okay, so I am on paper trading just for demonstration purposes, but when it comes to getting in a trade, whether it be a limit order, so you're setting an order in advance, and when the market reaches this point in time or this point in price, this is when you get in the trade. Whether it be this or a market order, you should always have an area that you're looking to take profit at, and you should have an area where you're willing to take a loss at. The stop loss basically protects you from losing way more than what you could. And then the take profit ensures that you are locking in profits no matter what. So when it comes to, at least for myself, when it comes to setting stop losses, I typically always look for that 1 to 2% range. Now, then again, it always depends on what type of trade I'm taking, because when you're in different markets, you can, depending on the trade you're taking and your strategy, you can maybe even move that stop loss to about 0.5 or, maybe 0.6%. But the general rule of thumb is to have a stop loss that's sitting at about 1 to 2%. Then again, it also just depends on what type of trader you are in this game. Now, when you're an investor, it's a bit different because you can be willing to take a bit more of a percentage drop within the market. But that's also because you are now holding for really months and years, in fact, right? So investing is different. And that's why it is important that you do understand what type of player you are in this game. But the most common reason for individuals losing money in this market is not due to them not having a good strategy.
Is A, what you do with the losers, and B, how your portfolio is constructed. Time and time again, is the natural human instinct is basically to cut winners too early and to run losers for too long.
If you're entering the markets without proper risk management, you're essentially gambling at this point, and this is where most people tend to lose money in these markets. You guys got to remember, trading is all about emotions. If you trade and you are afraid to lose money within your account, you will fail in this business, because you will be controlled by your emotions. And ultimately, this will affect your trading decisions.
So you've got to be objective as well. Generally speaking, you need to be like a sponge, just absorbing as much information as possible. And then one of the key aspects is working out what is noise and what is actually important to either your trade idea or your actual position.
In these markets, you have to be okay with taking profits early and even getting stopped out, because even if you do take profits early, you still made money. And even if you get stopped out, it can actually be a very liberating feeling because you're no longer holding on to that losing position.
It's a relief because I don't need to think about it anymore. So what do we think it takes to be a good trader? Knowing your own strengths and weaknesses is so important, because if you don't know your own strengths and weaknesses, the market will kind of find them for you very quickly.
Which it could put you in a drought. There was a stock that I talked about a while back, and it's not to say that this is a bad stock and that they don't have their time coming up. I very well do believe that they do. But when I was entering in on the market, they weren't ready yet. And you can't try to impose your own will upon the markets. Like this stock right here, Jet.ai, I very well do believe that they are on the verge of seeing a very strong move in the market. But like I said, when I was entering in, it wasn't time yet. And that's okay, because like I said, depending on what type of player you are in these markets, you could start dollar cost averaging in, and that's the key to dollar cost averaging, right? But then again, you got to realize, okay, is this trade benefiting me right now? Or would it just be better for me to let go and then free up some capital so then I can continue trading some more? Because that losing position that you hold on to could be the reason why you do blow up your account. So I had to come to a conclusion, because I set a mental stop loss. And I promise you, when you set mental stop losses, man, you'll lose some money doing that.
Have a stop order on every trade you do and never change your stop order midstream. Okay, so never revenge trade when you'll come back from a bad day. You'll come back from a bad week, but you'll never come back from being up $500 and by the end of the day you're down $8,000.
And this is why it's important that you do have your own risk management rules that you stay consistent with and that you're disciplined with. Because if you start breaking your own rules, then you'll start to ingrain that into your subconscious mind. And this is where understanding your time frames is vital. Because if you know that you're a swing trader, so you're typically holding for maybe days or weeks. Like if you're holding for months, you're now investing, okay? But if you're holding for days or a couple weeks, you're considered a swing trader. And if that's the case, okay, you might be okay with a bit of a drawback, But if you're just sitting there waiting for about 2-3 weeks and nothing's happening within your trade, you at that point you might as well just let go of the market. You might as well just let go of that trade, move on, and if it pumps, it pumps, and if it dumps, it dumps.
We know if we're going beyond 2 weeks and this hasn't done anything, again, we're probably in a hope trade, and it's probably not going to work well for us. So we want to understand how patient we should be with the trades. Oftentimes I see traders getting into a trade, waiting for something to happen. It doesn't happen. Then they get out, and then for sure when they do that, it's going to happen. It's going to be in their favor. But one of the reasons why they have a tendency to do that is they're not sure how much time to give that trade. So whether we're talking about a day trade or a longer term trade, the other aspect of that is that we don't want to ask something from the market that the market can't give us. So that we don't want to say, get going when it's a time period where we have very low volatility in this market.
If I start focusing on the potential gains, or if I start focusing on the losses that I'm taking, that's when FOMO starts kicking in. And FOMO is, it's like FOMO is basically the poison in this market. It's the primary reason for traders blowing up accounts. So if you got a market where you're like, okay, I got stopped out, but I feel like I know, not feel, you can't base it off of feeling. You have to know, okay? You have to know that you have the right setup. You got to know that your strategies, you're looking at the market the right way. If the market didn't pump and you got stopped out, well, then just enter back in as it starts to drop a bit lower, and maybe that'll help you understand, okay, I see why it would have been better for me to have entered down here opposed to where I did enter. If I'm looking to take this trade here, I have a setup, I got the fair value gap, I see that we're now in a downtrending market, and I've talked about this before in my previous market structure video, so if you guys want to check that out, feel free. But let's say the market pulls up. I know that this is where I can get a real nice entry on this candle's low. It's important too that whenever you are making a trade, you always should always be able to make more than what you're losing. Robert Dennis, he was one of the greatest traders to live, and he made, I think, over $400 million in these markets. It's not because he needed to win every single time. It's because his risk management rules were so good that he only needed to win 10% of the time in order to completely outweigh all of his losses. You can lose 10 times in a row, and that one win that you have can completely outweigh and override every single loss that you just accumulated. And it is very likely that you will experience times of downturn. Now, that doesn't mean you want to be losing 90% of the time, because for a lot of individuals that will mess with your psychology. But it's just an example, because even your big institutional traders, almost 99% of them don't win more than 60% of the time. And that might even be a bit of a stretch. So it just goes to show that even your biggest players in the market are only right really half of the time. But because they have such strict risk management rules and management rules that allow them to win way more than what they lose, doesn't mean it's like that every single time, but majority of the time it is. It then allows them to now take a trade and be able to, if they lose not that much money and keep going on to see another day. And if they win, it gets multiplied. So in a trade like this, you could even take a stop loss sitting around 0.6%. So you don't even have to take that 1%. Now, keep in mind, this is in the daily time frame, but this would be like, this is applicable even if you were to drop into a lower time frame, right? So if I was to take this trade, I'm only risking 0.6, but I'm only risking $77, but I can make 154. And I already know that this is a good setup because I've tried it out. And this is where paper trading really can play a big role when it comes to learning the dynamics or just practicing. Practice does make perfect, right? But it's how we practice that's the important part. And that's why institutional traders will say, like, it is important that you do start entering the market as soon as you can with real money, because when there's money on the line, the psychology, it alters a lot. It gets altered a lot differently. So you might take this trade right here. Boom, you're in on that trade. And that's a real nice trade right there. So right there, I would have made $154, whereas I only would have lost 77. So I still would have been able to trade to see another day, even if I didn't win.
If I'm up and I have reached my limit and I turn my machine off, if I'm up $1,000 Okay, or I reach my limit, I turn the machine off and go home. What you never want to do is turn a winning day into a losing day. If you ask any retail trader, have you ever been up 1,000, you thought you had diamond hands, you start betting, trading irresponsibly, and by the end of the day you're down 4,000? You turned a winning day into, it's the worst feeling in the world. You're kicking yourself in the head going, at noon I was up $1,000 and now I got to go to the ATM 4 times. How stupid is that?
And it's worse than losing money.
It's way worse than losing money.
Yeah.
So that's turning a winning trade into a losing trade, and that's turning a winning day into a losing day.
A general rule of thumb I typically like to follow is my stop loss always has to be at least above 0.5%. And that also depends on the type of trade that I'm taking. But generally, I always like to keep at least above 0.5, because when you take that stop loss and make it too tight, that's where you can lose on a very, or what could have been a very profitable trade.
When we do our modeling, what we find is that if you use too tight of a stop, okay, you will drop your win-loss ratio way down, because you'll end up getting stopped in the noise more often than not. So with all our testing, no matter if it was a retracement trade, a counter trend trade, reversion to the mean, a breakout trade, all these types of things, didn't matter how we modeled it, it always deteriorated the system and the results if we used too tight of an initial stop. And I see that happen to people all the time. They've got the right idea and they get jiggled out in the noise because they get nervous or anxious.
It always depends on what type of strategy you have and how much you've practiced using the strategy. Because if you've practiced using the strategy and you know you can now take a bit of a tighter stop loss, you don't even have to follow the same rules that I apply to the markets. And that's why I always say, any strategy that you end up using over time will ultimately be your own strategy. But it is always important that whenever you take a trade, you give the market a bit of breathing room. At least in my opinion, you know, you have to practice your strategy and really work with it. But let's say I was going to take this trade right here. This is us breaking outside of this range. And like I said, I did talk about this in the market structure video, so you can get setups like these. But let's say I take this trade and I'm like, okay, I see this fair value gap here. So I know that as we start moving in an uptrend, it's very likely that the market will drop back into it, and then we'll start seeing that pump. So let's say I set a position here, but my stop loss is too tight. You know, I got my take profit resting up here, but let's say my stop loss is there. You might take the trade and get stopped out too early. Doesn't mean it wasn't going to be a winning trade, but because your stop loss was too tight, you now lost out on what could have been a very good trade. So you always want to have you always want to have a rule of thumb that you follow when it comes to, one, what type of trade you're taking, two, the zones you are going to set your stop loss and take profit at, and three, the general time frame that you're willing to hold a trade for. Because if the market's sitting stagnant for a while and you're a trader, okay, then you might just hop out and go find another setup. But just because I took this loss here does not mean that this strategy wasn't a good strategy. Doesn't mean I didn't follow my rules. You know, well, here I technically didn't, but I'm trying to show you guys as an example, like when it comes to approaching the markets, you have to take it as a business. You can make money in this business and you can lose money in it as well. But don't get caught up in the idea of being a winner or trying to avoid losing, because that's what builds pressure within yourself. And honestly, the best traders are traders that know how to lose.
The most consistent problem that I see every day with aspiring traders is this: they don't want to lose. It's not about winning and losing. It's about performing.
So we don't want to try to avoid losing, but we also don't want to lose. You know what I mean? Like we at the end of the day, you're trading because you're looking to win. You're looking to be profitable in this market. But when you start imposing that upon yourself, now you're adding pressure. And this is when you can't think clearly. This is when a lot of times either FOMO kicks in or we just don't even take the setup that we originally have for ourselves. We want to manage our risk in a way that allows us to survive another day. And if it doesn't work out, then that's okay. And if it does, then that's even better. Now, this is another very common mistake that traders or even just individuals make in these markets, whether it be with investing or with trading. And that's not taking profits when you could have. Let's say I have this trade setting up here, okay? And I go on a long position, right? I have my risk management rules, you know, I'm sitting at about, get in just below here. I have about a 1 to 2% stop loss, and I go for a long. Now this is a real deep long, but this is just to show you guys for an example. Okay. Now look at this. Let's say I get in on this trade, right? Nice trade. I'm in, and the market starts moving in my favor. You are now currently up on this position and it's looking real nice. But this is where most individuals also lose money because they don't take profits when they could have.
I place a trade, then I place a stop, and I leave an open target on it, and then I leave the computer screen. That's the only way I've figured out without messing with it in order to take myself out of a profitable trade. Because I don't know about you, but I never get smarter once I'm in a trade. I almost always make the worst possible decision I can once I'm in a trade. So best thing for me to do is just leave it alone. I'm a big believer in scaling out, especially on index futures. I go all in and I scale out half, quarter. And what I do is within 3/4 of the trade position, I always do it mechanically. The last quarter, I'm always swinging for the fences and trying to hold on to it as long as I possibly can.
You let that last quarter go all the way to your stop?
Yeah, unfortunately, sometimes I will. It's just a, double-edged sword. I don't want to tighten up the stop so tight to where it's like a leash with a dog around my legs and tangle me up and trip me up. So I have to loosen it up a little bit in order for it to take advantage of some of the market gyrations and give it a chance to actually grow.
Like if I'm already up this much right now, I would take off a portion of my position. Doesn't mean I'd take off the whole position. This is when you start kind of slowly taking pieces off of your trade. So this is why having your zones already identified is very important. So you want to have typically like that deep range, and that's like your final take profit. I generally feel, at least for me, whenever I approach a market, I have 2 to 3 take profit zones. So as you guys will see here, I had a very nice trade going. I was already up 15%. That's very good. That is very good. But because I never took profits when I could have taken profits, it ultimately led to me losing out on profits altogether. This is where a lot of individuals now start allowing their emotions to be reflected onto the markets, because then they start thinking to themselves, oh man, I could have taken profits. I could have gotten the pump. I didn't take the pump. And then we start questioning what the market's going to do next. You got to understand, one, what type of player you are in this market. What market are you trading? Are you trading the stock market? Are you trading the Forex market? Are you trading the futures market? Like, identify what market you are in and realize that if you're in the stock market, the market, when it pumps, if you know what you're getting into and you know the time you're in, like when it comes to the market cycles, it's very likely that if you're in a good asset and it just seen a pump and it's coming back down and it's consolidating, that there's going to be another pump coming. But if you're in like a forex market or something, you know, the market dynamics are different. Altogether, a chart is a chart, but markets do move differently depending on what market you're in.
Pick a market or a sector or a futures market that you find of interest, one that sparks your interest in the market.
So you do got to understand, you know, what type of trader or investor are you in this space? So this is why it is important that we set take profits and stop losses no matter what, whether it be with investing. Like investing, I set take profits. Trading, I said take profits. I said stop losses. And it's not to say that it was always that way. Like I've lost money due to this stuff too. But that's why I'm showing you guys it now, so that way you can start applying this information and, you know, start feeling it out for yourself. And if you did everything right, if you followed your setup, if you had your stop loss in the right position, you know, you followed your rules and you still lost, that's perfectly fine because it will happen.
Ultimately, in trading, completely different than other endeavors, no matter how right you are, no matter how everything lines up and how sure you are, you can still be wrong and you can still lose. That's the vulnerability. That's the piece where literally the trader has to come to a moment where they are comfortable with their vulnerabilities. Those vulnerabilities are literally about inadequacy, mattering, worth, and power. And when you do really honestly let go of the illusion of control of outcome, you come face to face with this. That is trading.
It's how you manage those losses and how you learn from them that's the important part. Because if you did every single thing right but you still lost, then that's just the market. That's just the market. Doesn't mean that your strategy doesn't work. It just means you got to do it again. But without proper risk management rules, you might not have the ability to do it again. And you guys got to remember, losing is a mindset. Winning is a mindset. It's all a psychological game. That's why the best traders in the world say that trading is a psychological game. Now back to Jesse Livermore. I was just talking about him earlier in the video. This guy accumulated millions in the market. He has some crazy stories as well and very timeless wisdom that you can learn. But his downfall was that he didn't follow his rules. You know, it's funny. This guy used to, when he like made millions out of the market, he would literally go in the bank and just sit in the vault with the money. Kind of, you know what I mean? Like just immerse himself within that kind of aura, which I can respect that for sure. But because he allowed the idea of winning get to him, he stopped following his rules. And he literally said that the reason he lost his fortune in trading wasn't because of the market. It was because he didn't follow his original set of rules that he set for himself. He didn't follow his methodology, which ultimately led to his downfall. But because he didn't follow his rules, he lost all of the money that he made. So that's all I got for you guys today. I hope you guys enjoyed. Honestly, I think if you guys are just starting out or if you are already experienced, regardless of money you have lost, if you have lost, it doesn't matter. It's just your approach that you take to the markets in the present that matters. How do you come back from the losses? That's what matters. So don't let the wins or the losses define who you are, whether it be with trading or just in your own personal life. But anyways, hope you guys enjoyed. Stay blessed from the best. Peace and love.